In this video, I want to go over the pros and cons of a SEP IRA account for retirement planning. This SEP IRA account can be very effective for an individual that's self-employed. There are ways on how an employer could create a SEP IRA account for their employees, where only the employer can make contributions towards those plans. But in particular, with this video, I want to discuss for an individual that is, their only employee of the business, how this could be a more effective option than somebody just leveraging a traditional IRA account with smaller contribution limitations to it. So I'm going to go over the differences between a SEP IRA and traditional IRA. I really think that that's how you guys are going to really understand these things, and then show different ways on how the tax deductions work with those, how you could customize those specific accounts, and how you could customize a new account each year. So in some years you might make more money than in other years, so maybe you could ramp up the amount of contributions you're placing into your SEP IRA account in one year as opposed to another year where you might reduce that a little bit further, and just kind of, going over everything that you'd really need to know about a SEP IRA retirement plan. So a SEP IRA stands for a Simplified Employee Pension Plan, SEP. Typically, these are most effectively structured when you have a sole employee of the business who's also the business owner, so a self-employed individual. What happens, and really where I show you the distinction, is understanding how a traditional IRA works for that individual versus how a SEP IRA works for that individual. So if we're looking at a traditional IRA or even a SEP IRA, and we think of it like a bucket, there's two ways on how this bucket grows. One way is by the contributions that a person's making into their individual retirement account, traditional IRA, and then the rate of return that's coming back. So with a traditional IRA account, if somebody is below the age of 50, for 2022, the most that they could place in there is up to $6,000 of contributions into their account. So their monies are being contributed into this account, which is obviously adding dollars into this bucket, and then they could link it to different strategies, whether that be investments, whether that be fixed accounts, whether that be fixed indexed accounts, safe accumulation accounts. There's a whole multitude of different ways on how somebody could create a traditional IRA. A traditional IRA is a qualified pre-tax retirement account. So the monies that are getting placed into this account are getting tax deductible or are having tax deductions being added into the account. The rate of return that's coming back is growing this account, so you're growing tax deferred, the power of compound interest. So whenever they want to take distributions from this account, they have something known as 59.5 rules, meaning they cannot pull monies before age 59.5. When they do, these monies are going to be fully taxable. If you try to pull monies from your IRA account before the age of 59.5, you're going to get dinged with an additional 10% penalty because you did not wait until at age 59.5. So the benefits of leveraging a traditional IRA versus employer-sponsored plans such as a 401k, if somebody was an employee, would be this rate of return. Basically, with the customization that somebody has, whether that be with investments or fixed accounts or fixed indexed accounts, whatever that is, you have thousands of different options, thousands of different eggs in your basket to choose from to customize these options better. The contributions, let's say if we have an example where somebody's making $100,000 in a given year and they contribute $6,000 into their account, their adjusted gross income is going to be reduced by that contribution because it's a tax deduction. So it might show, if all things being equal, for a really simple example, this individual is now making only $94,000 because $6,000 went to a tax-deductible account, it basically went pre-tax into a qualified retirement plan. So you're getting your tax deduction now. It's growing tax-deferred, going to be able to pull monies tax that's going to be fully taxable later on. And if they're above the age of 50, that contribution limitation is raised by $1,000, and that's basically talking about the 2022 tax year. If you're watching this video in a different tax year, obviously, look up what those max contribution limits are for a traditional IRA. Now, a SEP IRA works very similar. Still think of it conceptually like a bucket. The main difference is this is for self-employed individuals, or how it could be leveraged effectively is for self-employed individuals, but their contribution limitations are significantly higher than a traditional IRA. So the monies are going, it's a pre-tax qualified retirement account. You have contributions that are going into the plan, the rate of return that's coming back, so that's growing the account tax deferred. When it comes time to start pulling out monies, they still have that 59.5 rule, and meaning that after age 59.5, whenever they take withdrawals, it's going to be fully taxable. If they try to fully remove these dollars before age 59.5, they're going to get dinged with a 10% penalty. So very similar with the traditional IRA and the SEP IRA. but the main difference is this contribution. If somebody's making, meaning their compensation within a given year, they could contribute the lesser of $61,000 in a given year or 25% compensation. So what that means is, let's say if you have an individual that makes $100,000 in a given year and they own their own business, they're their own employee, they could contribute $25,000 into this account. That $25,000 is going to be tax deductible. That could reduce their adjusted gross income. They're placing it into an account that could appreciate in value. They're getting their tax deduction now. It's going to grow tax deferred and be fully taxable later on. $25,000 was in this example because it's going to be the lesser of $61,000 or 25% compensation. If, let's say, somebody was compensated through their business or as a self-employed individual and they were compensated $400,000, in that example, 25% of $400,000 equals $100,000. Well, if we look at what the contribution limit is, it's the lesser of 25% or $61,000. Because $61,000 is less than $100,000 in this example, the most that somebody could contribute is $61,000 into their SEP IRA account. So as you notice the difference, if let's say an individual that's below the age of 50, the most that they can contribute into a traditional IRA is $6,000. The most that they can contribute to a SEP IRA account is $61,000. On top of it, the way on how this rate of return works is through the performance. So that same sort of customization, which makes a traditional IRA attractive, has that same customization opportunity with SEP IRA accounts. So you could set them up with different investments. You could set them up with fixed accounts. You could set them up with safe accumulation accounts, fixed indexed accounts. So there's a whole multitude of different things. So each year, an individual could, let's say if they have a really good year and they're making compensation of $400,000 one year, and then they only, get compensation for $100,000 the next year, what's the difference there? Well, that means that they could place up to a max of $61,000 that first year, and then a max of up to $25,000 that second year. The next year, let's say they make $200,000. Well, then we know 25% of that $200,000 number is $50,000. $50,000 is less than what the max contribution is, so the most that they get placed in there is $50,000. So that's how you could control those contributions. Very effective way for tax planning, for tax deductions, being able to hoard dollars into these sorts of accounts because those contribution limits are so high, and also the flexibility on these accounts are, they give you really good flexible options to make sure you could tailor it specifically to what you're trying to accomplish during your retirement years and for your retirement planning needs. Now, some of the things I touched up on, but they're very important to know, is withdrawals are fully taxable. When you're taking monies out of your SEP IRA account, because you're getting a tax deduction, it was growing tax deferred, those monies are going to be fully taxable when you hit your retirement years and you start taking withdrawals from it. You have 59.5 rules. So unlike a 401k account where you might have 55 rules, meaning that if you're at least age 55, you could start taking withdrawals from that account if you're no longer working for that employer, this is 59.5 rules, so it's very similar to how a traditional IRA works. Typically, that's not going to be a make or break with the situation because individuals are looking to at least retire at a minimum of age 59.5, 60, 65, whatever that case might be. But just be mindful that 59.5 rules do still apply. If you try to pull out monies before age 59.5, you're going to get fully taxed on those dollars and get dinged with an extra 10% penalty. These are monies similar to a traditional IRA. You have something known as required minimum distributions that are associated, that are correlated to this plan. So just like you cannot pull out monies before age 59.5, you have required minimum distributions, which were changed from age 70.5 to now age 72, where they're going to force you, the IRS forces you to start pulling out monies from your SEP IRA account at age 72, a little bit portion higher and higher and higher. So you could create different strategies to make sure that that's going to be effective if you don't need those monies. Similar to the negatives of a traditional IRA, a SEP IRA, whenever you take out withdrawals, because those are going to be fully taxable, that's going to also increase the amount of provisional income calculation when you're triggering Social Security income. So on a worst case scenario, an individual as it currently stands could have up to 85% of their Social Security income taxed. If you're taking monies from a SEP IRA account, just like a traditional IRA, just like a 401k, and there's a whole slew of different things that if you're pulling out monies, if you're taking withdrawals from those, it's going to increase the amount of provisional income, which will increase which can increase the amount of Social Security taxation that somebody pays on their Social Security income. So you've got to be careful on this and make sure that you're staying underneath the cusp. One way to be effective with, avoiding that Social Security tax or increasing the amount of Social Security, the provisional income calculation, is by taking SEP IRA accounts and converting them into Roth IRA accounts. So that's something that a lot of individuals are not familiarized with, that SEP IRAs do give them the opportunity. Just like a traditional IRA, SEP IRAs allow individuals to take their monies from a SEP. So even if these are SEPs that were established for the last, 2, 3, 5, 10, 15 years, and they're either setting in one SEP IRA account, or you have, a whole multiple of SEP IRA accounts, one that could be segmented for investments, one that could be set up for a fixed account, one that could be set up as a type of money market cash account. You could go and take those dollars and you could do conversions into Roth IRA account. Lastly, from a flexibility standpoint, it's very flexible. They're very easy to set up, meaning that you could even contribute to a SEP IRA for the previous tax year, similar to how you could set it up with the traditional IRA. So like as an example, let's say if you're in February of 2023 and you want to place monies into a SEP IRA, make contributions for a SEP IRA established in 2022, you could do that. There's specific cutoff dates. So anything regarding when you're reviewing this video, make sure to talk to your tax accountant, your CPA, to make sure that you are eligible for these different tax deductions, different contribution limitations. But for the most part, they're very easy to set up. They're very easy to set up on a customized way, meaning that what an individual is trying to do, where they are right now with their point A, where they want to go with their ideal retirement date, how to make sure that you're creating these SEP IRA accounts to not only reduce the amount of taxable income that an individual has for the year, but make sure that that's contributions is going into an asset that is appreciating in value. That's the whole purpose of a SEP IRA. You're placing monies, you're saving it, and you wanting this asset to grow, whether that be with investments or, whatever you create within that SEP IRA account. So how to get from point A to point B successfully, and then make sure when you do hit that ideal retirement date, how to make sure that you're taking out distributions properly and you're growing any excess accounts to, leave for, as a legacy planning, leaving for loved ones, using it as a splurge account, as a type of vacation account, whatever that case might be. But it's just making sure that you're taking the steps now so that it's organizing you to get set up and really leverage these accounts, leverage the opportunities, as opposed to just saying, oh, I made, 400,000 this year. I made 200,000 this year and I'm only placing in $6,000 into my traditional IRA. Well, if you're a self-employed individual, you can leverage a SEP IRA and leverage your dollars much more effectively than being, pigeonholed into that traditional IRA with those lower contribution amounts. The process for creating a SEP IRA plan is very simple. The mistakes that are made are individuals not knowing what to do or how much to place in there, how to make sure that they're matching their contributions of a SEP IRA to a customized strategy that will help them create an overall retirement plan. So with retirement planning or financial planning in general, when somebody's younger, they typically want to stay within a wealth accumulation strategy. When they start nearing their retirement age, their ideal retirement age, they're going to want to transfer that risk into more of a wealth preservation and distribution strategy. Those are the different things that we help out with. So if you individuals could obviously do that on their own. If you need any help or you want to have a further discussion on this, feel free to give our 1-800 number a call. It's 1-800-566-1002. We'll show you how to create the account, how to set up the account, how you fund the account. Now you could fund the account on different flexible options. You could do it sporadically throughout the year. You could do it in one lump sum, dollar amount. You could wait until the end of the year. So let's say if you create the SEP IRA account and it's sitting at a $0 balance, and then you're walking into February 2023, and you say, okay, I realize how much money I made for my 2022 year. Now I want to place, $40,000, $30,000 into my SEP IRA account. So you could actually fund it after the fact. You could fund it. Now there are specific cutoff dates for individuals with a SEP IRA contribution for the previous year. So just be mindful of it. You don't want to wait, years on end or months, beyond months. It's really in the beginning of the year is when you want to set that up. But there's a lot of flexibility with this. Flexibility on how you can customize the different, investment strategies in there, the growth strategies in there, income strategies. Individuals could also leverage annuities with SEP IRA accounts. the ways on how you could start placing monies aside, knowing that they're going to grow, and then you can trigger income streams later on. So you're almost creating your own type of personal pension plan through the SEP IRA account. So there's just a whole slew of different things you could do. SEP IRAs are fantastic for the correct situation. It could be a really bad thing for the wrong situation, really, based upon the taxation, based on how much income somebody's making. Like as an example, if somebody's making only $10,000 from a consulting gig, that might not be the best thing to go into a SEP IRA. It's not really going to really make a difference. But if somebody's making some sizable income from this and they want to be able to contribute better, that's where a SEP IRA could come into play. If you found value in this video, feel free to give us a call. Make sure to reference this video so that we could assign the correct advisor for your specific situation that deals specifically with SEP IRA accounts. Feel free to visit our website, which is afasifinancial.com or retiresharp.com. They both bring you to the same place. And feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. I hope that this helped, and thank you so much.